Okay, good morning, ladies and gentlemen. Thank you for joining us. This is our latest series of webinars with Eve Siegel of Siegel Asset Management Partners. My name is Paul Duran. On behalf of the entire team at ELCO Management, I would like to introduce Eve, our sub-advisor for the income infrastructure and energy transition portfolios. I would like to remind everyone that today's call is being recorded and that a replay will be available. And on the screen now are some important disclosures. And with that, Eve, I'll hand it to you.
All righty. Well, yeah, thanks, Paul. Really fortunate to have management team of EQT with us. Toby Rice, CEO, Jeremy Knop, CFO, and Cam Horowitz, who heads up investor relations. So welcome, everybody, and thanks so much for joining us. Just a level set, EQT is a vertically integrated natural gas company. It's one of the largest natural gas producers in the United States. And just recently, EQT completed the acquisition of Equitrans. And I think that was just over a month ago. So maybe, Toby, can you describe the industrial logic for buying Equitrans, which is a midstream pipeline and gas gatherer company that was actually a part of EQT back in the day, and how's it going?
Yeah, that certainly, Yves. And just to take a step back and just give the audience just a review on sort of where we've been since taking over 5 years ago. Yves, we just had our 5-year anniversary since taking this company over back in 2019. So we've reflected on some of the progress that we've made in that short period of time. Some of the big level metrics at EQT that have moved significantly. Our productive capacity has increased over 50% during that period of time, from about 1,500 BCF per year to now almost 2,300 BCF per year. Our cost structure is down 30%. From $3 now with line of sight with this Equitrans transaction to a $2 cost structure. That's the price we need to begin generating free cash flow. That's a massive move. And as a result of those two things, our free cash flow generation has increased 7-fold over that period of time. Now we have issued shares to make this happen. Now we're very, very active in the M&A space. So when you look at this on a free cash flow per share basis, we've doubled the free cash flow per share generation of this business. So how we produce these results? I think for us, it starts with just like a super heightened focus on cost structure. That has been the North Star for this company. We think as a commodity business, it's the true differentiation of your business comes through your cost structure. And when you have that mentality, it's no surprise that a company like E-Train would be significantly accretive to us on that front. So Equitrans, buying in Equitrans allowed us to take our cost structure from like that $2.55 level down to the $2. So that is a massive move for us. And on top of that, because this is our pipeline provider, there are hundreds of millions of dollars of operational synergies between the two companies and the organizations, and the teams are working hard on those today. Those are all upside to our forecast. So I'd say over the last 5 years, the one thing that's been really challenging is we've done amazing things. The teams have done amazing things in the field, increasing well productivity, taking costs down. But it's almost always felt like we've been fighting with one arm tied behind our back. Now that we have control over the water, we have control over the gathering systems. We can have a lot more control over our destiny. And we're excited about delivering the synergies over the next, couple of years.
What's changed in the thinking from upstream separating their midstream business to now? I think you're probably the leader of an upstream company buying their midstream provider. What's changed in thinking?
Yeah, so in the past, we're just at a different era of shale. I mean, we call this the sustainable shale era. This is all about generating free cash flow, and that means it's all about lowering cost structure. People split up their midstream. Back in the day when the shale rush was taking place, people would rather spend their money buying land, doing exploration, growing production. Those days are behind us. And then there was a period of time where, some financial engineering. I think people thought they were going to create value by separating the business. That was the driving factor of EQT splitting out their midstream back in 2018. And I think when you do that, it's just it didn't really have the impact needed. And now we're back into the sustainable shale era. So, the cost impact of this transaction is so transformative. We get a lot of questions from our investors. Jeremy and I just got back from California, and this is a really interesting deal, Yves, because when we announced the deal, stock was down 10%. Cam was very sad. But when it got time to voting on the deal, 99% of shareholders supported the deal. And the one question we're getting now is, why don't other upstream players go and recreate this same type of transaction that we did? And I think this is a once in a lifetime opportunity for EQT, and I think it's not an opportunity to buy in your midstream available to other peers. It would be tough for a company like Chesapeake to go out and buy their gathering in from Williams, and not pay they'd have to pay a really significant price. That would probably be extremely dilutive to them and cause investors concerns. We had a unique situation where, E-Train with MVP and the issues there, it was a good time for us to combine forces, and we're excited about the stars aligning for this one to happen.
Yeah, and just a follow up to that, the folks on the call here, they might not realize that you have experience also. You owned, or you have Rice Midstream, so this isn't unique to you, to the management team, managing a midstream company as well.
Yeah, correct. I mean, we always thought midstream and upstream needed to stay together. A lot of these assets that we're operating were built by Rice Midstream Partners, our midstream subsidiary during Rice Energy. We were, at the time, we were producing about 2 BCF a day gross as an upstream player, but our midstream team was gathering almost 3 BCF a day of natural gas. It was a really great, they were a really great bolt-on to our business, not only to make sure we can stay on schedule, but they were able to go out and leverage third-party business to increase the utilization of our systems, and that made the returns on those projects, were really attractive. So hopefully we're gonna recreate as much of that as we can, but a lot of the big midstream build out is sort of behind us. So this is just really going to be a great opportunity for us to harvest a lot of cash flow from these assets by saving money by the upstream guys.
You've also been a big consolidator, both upstream and now you have E-Train. What are your thoughts on consolidation, further consolidation? And the second part of that is how do you think of E-Train as a business in terms of, it's obviously synergistic with your upstream, but do you see growing that as well?
Well, Jeremy has actually been one of the driving forces behind our M&A program. So I'll let him put some thoughts on that.
Yeah, I mean, look, I think when we came in, we did a pretty, I think it was like trying to be as unbiased as possible, looking at our business, thinking about like, what are we really good at? Where are our weaknesses on an absolute and relative basis? And really what stood out to us was just the out of market midstream contracts that EQT had been saddled with from when Equitrans was created. And going back to what Toby said, the whole desire to sort of financially engineer value, which obviously is not a lasting way to create value. And the best thing we thought we could do to alleviate that is dilute that away by acquiring other assets with midstream. So you'll see that as a constant trend. It's something we've harped on a little bit. And really for years, even, I think before Toby even took the company over during the proxy battle, I mean, he and I had discussions about, if we're really to fix Equitrans, that's really the thing we have to do. my prior life, I actually made an investment in Equitrans in a preferred in like 20, I think it was 2019. And I remember we diligenced Equitrans at the time, and EQT, and what we took away was these businesses are codependent, right? And so to really fix it, you got to put it back together again, which is why we nicknamed it Humpty Dumpty. So when we look at the business now, we say we have the highest margins of anybody. And when you stack margins, capital intensity, we have the lowest cost structure by a mile. When you look at inventory depth, we're unmatched. And just when you look at the ability for EQT to sustain what we do and with core inventory, we don't see a peer that really comes close. So in the past, we said there's a lot of opportunity from a consolidation perspective that makes EQT better. We can dilute that, probably the highest cost structure of peers down on the midstream side, lower. So it was Alta, Tug Hill. I mean, you go down the list. Even the Chevron assets we bought actually owned a piece of a Williams gathering system. But where we sit today, we say, well, we've actually raced to the front of the line by a pretty wide margin. So for us, when we think about consolidation, we're big believers in it in terms of the value it adds to the industry and just the stability, both for service providers and all employees, all partners. But it's hard for us to look around and say there's anything else that's going to improve our business at this point. So I think we have sort of, crossed an important threshold in sort of the life cycle of our business, sort of from a transformation era more to the next phase after that. So I think we're open-minded about M&A, but I think we're gonna look at our own stock as the litmus test, and unless our stock reflects, I think the sort of super premium it deserves versus any peer and how it trades, you're going to see us use cash to buy our stock back, and that is just kind of the day in day out acquisition target. So I think it's actually it's great for shareholders because you don't have to worry about what's going to come next, that uncertainty. It's something where we can just operate the business, squeeze synergies, generate cash flow. And just for perspective, like at 275 gas, most, if not all of our peers will be free cash flow neutral or negative. We'll be generating $1 to $1.5 billion of free cash flow per year, right? So think about the opportunity in that sort of world. Everybody gets bearish on gas for another cycle. If that happens again, and I think we'll be in a position to say, you know what? Our balance sheet's clean, our cost structure is unmatched. We could just put that cash into consolidating our shares. So, it's a different world. I'd say we have a real moat around the business at this point, which is hard to say in a commodity business. But I think that's really the result of everything that Toby talked about we've achieved in the past 5 years.
Well, you said a lot. So let me just unpack that just a little bit. So do you see, well, I was going to ask you, how do you see running E-Train in terms of, trying to run that business for growth? So that's, one part of the question. And then the other part of the question is more around, MVP as it relates to on the financing side, within, the thought process of deleveraging. So on the one side, how are you going to run the business? On the second side of the equation is on the capital allocation side, how are you going to delever? And, part of the delevering, and this, I guess, is a spoiler alert to your answer, is selling a minority interest in MVP. But you first have to do project financing at the MVP level. And then the very last part of that, and I'm sorry for a really convoluted question, is how do you see the expansion opportunities, on MVP? And you might want to describe, MVP as, a 2 BCF pipeline. And if you could follow my questions, you are a much better man than I am.
Let me take sort of how we're going to run the midstream business. Then you talk about the deleveraging plan. So, Eve, in our quest to continue to be a high growth business and the growth focused on free cash flow per share, this midstream business is going to be a platform that is going to create opportunities for us to reinvest in what we think are going to be pretty high return, sustainable growth opportunities. We're not seeing billions of reinvestment opportunities right now, but it is going to be another opportunity set for us to make really great investments. I'd say one, just an example, is our compression project that we've outlined. This is part of our $175 million of synergy per year of synergies that we've identified. Over the past 5 years, we've seen our gathering lines, the pressures on those grow from 400 psi to 1,000 psi, and the opportunity we have, and that makes it difficult for our wells to produce. So the simple fix is install compression. That will lower our line pressures from 1,000 back down to like the 250 to 500 psi level. We'll optimize there. But installing compression, we think we'll have an uplift on our base production. Now we're assuming about 10% uplift. In our last investor presentation, we put out 3 pilots for some of the compression pilots that we've done, and we've seen well productivity uplift ranging from 18 to over 25%. So we're being some conservative there. That's a few $100 million investment opportunity, but a really great example of some of the reinvestment opportunities we'll have. I'd say other than that, we're going to look to continue to maximize the utilization of this pipeline network. Yesterday, we just did a small little gathering deal. I mean, bringing more volumes into our pipelines, we're going to spend minimal capex on that. So, I mean, that's another example of like a super high return opportunity. So, in addition to capturing the synergies, maximizing utilization of this infrastructure with our volumes and others around us, we're pretty excited about how we're going to operate this network. And then, Jeremy, you want to talk about the deleveraging plans?
Yeah, so deleveraging, it's really 3-pronged. Organic free cash flow is obviously something that is price dependent. We've hedged between now and the end of next year a little over 50% of our production. It floors around $3.25 gas. So we protected a lot of that. The other 2 prongs are both asset sales. So the first is finishing the sale of the other 60% of our non-operated interest under Chesapeake, Northeast Pennsylvania. Equinor bought 40% of that already earlier this year. We are in the market to sell the other 60% of that now. And then the final one, which you alluded to, is on the midstream side. Our intent is to continue operating MVP and owning the majority of MVP. So we don't see any change in that respect. And the same with the other regulated transmission pipes. So what we're doing is actually, what we've said publicly at least is we're getting our MVP interest in the Hammerhead pipeline that feeds it, both brand new 20-year contracts. And we're pairing that with the existing, it's called transmission and storage, but just regulated assets of Equitrans. We're just putting those in like a holdco internally, and then we're selling a minority equity interest down in that to, I assume, a financial buyer. That box in total will probably have about $700 million of annualized EBITDA. And so there's a lot of market comps out there, 10, 12 times type levels. So, I think in our minds, at least a $7 billion, maybe $8 billion sort of valuation of that box. There's no debt on any of those assets today. So, it's pretty simple. You can solve for the proceeds you need. And effectively what a sponsor is bidding on is what ownership of that box. So it's relatively straightforward. We've got a ton of interest in that. There's actually in the midstream space, not many great natural gas opportunities to invest in of high quality, especially with long-term contracts. So I've had everybody from Middle Eastern investors to Canadian pensions to your traditional host of just U.S. infrastructure investors, all reaching out directly, trying to get involved in the process and own a piece of that. And look, doing that in conjunction with the operator is a pretty special opportunity. So I think that'll be a pretty good outcome.
So does that preclude you from doing a project financing on MVP?
Yeah, look, that's under consideration right now. We haven't made a firm decision yet. Whether you have debt at MVP or not impacts a sponsor being able to come in and back lever their own investment, which is traditionally what happens. If a infrastructure fund says I'm going to invest $2 billion, probably pull $1 billion from their fund and borrow the other $1 billion and give you $2 billion. The cost of that other $1 billion of leverage that they take out is influenced by the debt at the assets. And so we're being patient just to figure out that equation and what optimizes the outcome at the end of the day.
And what about the other owners of MVP? How's that sort of influence what you folks are doing?
It really doesn't influence our JV in MVP at all. So NextEra is our biggest partner there. There's a couple other smaller utilities who own interest as well. But you know what we do on the JV side would not impact anything with those partners, wouldn't impact anything as it relates to the expansion of MVP that we've talked about publicly. This is just a financing in the background that we'll handle that's purely passive.
And then when would you make a decision on the expansion of MVP? You might want to tell the folks, you know, it's 2 BCF a day, you know, what's the maximum that you could expand it by?
Yeah, so MVP is 2 BCF a day now. It's a 42-inch pipeline. You can add compression and push more gas through that, just adding horsepower on the existing compressor stations. So look, right now MVP cannot flow at full capacity until the downstream expansions on Transco are completed. That's slated for the end of 2027. So it's pointless to really spend CapEx and bring this online before that point in time when MVP can't even float its 2 BCF a day capacity now. So there is some optimization to do around timing of spend relative to timing of in-service to make sure you can even utilize it. So that's work we're doing right now. We fully intend to go ahead with that. We obviously need to work with our partners on that investment and make sure everybody's fully on board and fully really have that fully scoped out. But look, I think by our numbers, those sort of brownfield style expansions are very high returning. We estimate it's probably a 4 times, maybe 5 times at the most EBITDA built multiple for a pipeline that we think brand new with that length of contract is probably a 12 times type asset. So it's an easy kind of 2.5 to 1 investment without much risk.
Gotcha. So just to bring it to tie a nice knot, Jeremy, Toby, do you want to talk about what your capital allocation strategy is right now, and in terms of deleveraging, how much debt do you want to reduce it by, and that's the question.
Yeah, so our debt coming out of Equitrans is about $13.5 billion, pretty big number. So keep in mind, effectively the debt they had was just borrowed on a debt we owed Equitrans and our minimum volume commitments. So I mean, just to humor you, we calculated we had basically an $11 billion liability to Equitrans and just MVCs contractually. So we basically washed that away and took on $8 billion of debt. So there's, in our minds, $3 billion of liability we sort of washed out through the transaction. In terms of where we want to get that, our goal is by the end of 2025 to get that total debt number down to about $7.5 billion. We have $500 million of cash to date in the door from the Equinor transaction we've already done. Then we have between the midstream deal and the rest of that non-op, we think that'll eclipse our $5 billion asset sale target. You probably get to around $9 billion by that point with proceeds. And then it's just organic free cash flow to get you from that level down to the 7.5. So somewhat gas price dependent. If gas prices go up a lot, obviously helps you get there quicker. And then really after that, we're solving a little bit for the rating agencies, make sure we remain stable or get on positive outlook. We think it's strategic to get up to that BBB type level. So I think for the near term, our focus is going to be pay down debt. We do want to be a steady dividend grower. I think you should expect our capital allocation policy over the kind of medium term, like next 3 to 5 years, to reflect more so what like a major integrated just oil and gas company looks like, with a 3% style based dividend that can steadily grow, that's supportive, that doesn't get cut through the cycle. I think we want to be opportunistic with buybacks, but being able to do that is contingent on having a clean balance sheet and a really low cost structure. Otherwise, you're not in a position to do that. So we're trying to build towards that point. So near term, call it next 24 months, very heavy focus on debt, become more opportunistic after that. As interest expense goes down, we can raise the dividend and everything gets a little more in balance.
Well, would you have to wait 24 months before you raise the dividend again, or would you gradually increase the dividend while you do this?
I mean, I obviously can't say until we actually, get through the asset sales and see what this looks like. But my expectation is before the end of 2025, I think it's reasonable to assume we would consider doing that.
And then if we could, Yeah, I like to really achieve three things from this. One is talk about EQT and what a great opportunity, the stock is specifically. The second is to talk about the macro outlook. And then the third is to, get your thoughts on, energy transition or energy addition, so whatever you want to call it. So if we maybe move toward the macro, what's your view on natural gas prices, both short term and long term? And the question, I get all the time is, why are gas prices so darn low right now?
Yeah. So I think, our view on natural gas pricing is simply summarized by it's going to be volatile. How did we get here? I think there's a couple like key pieces of information that sort of drive our thinking that it's gonna be continue to be more volatile. Like biggest one is natural gas demand in the United States since 2010 has grown 50%. During that same period of time, pipeline capacity has only grown 25%. And most importantly, storage infrastructure has only grown 12%. What that means is that the lack of pipelines means that we're going to continue to have markets that are disconnected. That could create opportunities to connect some of those markets. But most importantly, the storage infrastructure, only being 12% in the face of natural gas demand growing 50% simply means that storage is no longer going to be an effective buffer on supply and demand. And that means price is going to be the factor. And so we think that, what do those prices look like in the low side and what should they be? And then on the high side, we think, natural gas price on the low side will be around $2. I think at $2, you see, what we're seeing now, which is operators will respond, curtail volumes. And that sort of supports and puts a $2 floor in the business. So it's pretty awesome to see that EQT with our cost structure being at $2, we will be able to generate free cash flow in a stress case scenario. That's a differentiator. Not many peers can say that. But then looking at the high side, we think that there's one other factor that's taken place and that is the retirement of a significant amount of coal, which used to be a lid on gas prices, in that $3 to $5 range. People would stop burning gas and switch over to coal. Well, with a significant amount of coal retirements, that lid is no longer as effective as it used to be. And we think, prices could shoot through that $3 to $5 range all the way up until they see industrial demand destruction. And that would be, prices in the $7 to $9 range. That is sort of what happened in 2022. So when we step back and we look at the situation, it's $2 low side, call it $7 to $9 on the high side. There's a lot of skew to the upside. And so for us to be successful in maximizing the value creation here, we think having a business that has a super low cost structure can generate free cash flow in any commodity price environment, but leveraging that so that we can mitigate hedging is going to be a key differentiator for us to capture the high prices when they come. Now, one of the only other thing I'd say I put out there is sort of our view on cost of supply in the U.S. Like, where should gas prices be? We believe that the marginal cost of supply is around $3.50, and that's obviously the Haynesville. And so if we had a perfect market, everything was connected, we have plenty of infrastructure, marginal cost of supply should drive where the prices will be. But given the dynamics that I mentioned before, volatility is going to override that. The only other thing I think that's happening that's worth noting is, operators are evolving the way that they're thinking about setting their activity levels in relationship to the gas prices that they're receiving and their cost structures. We've seen operators move from determining activity levels based on half cycle economics and now moving towards, well, what is my full cycle break even? That's that cost of supply. But what we hope to continue to see is people understanding that it's not just about breaking even. It's about generating return. And if you think that companies need to generate, call it 10% of their enterprise value, that would require another dollar on top of that cost of supply and put the marginal producer cost of supply, the cost of returns would be $4.50. that's the evolution of discipline that needs to continue to take place. Now, that's the setup. And so how are we differentiating ourselves? Because to thrive in a volatile environment, our game plan is low cost structure, mitigate hedging. People will say, well, there's other ways that you can manage the volatility. Number one that people say is you can hedge and just lock in your prices so you're not getting whipped around. Well, we think when you hedge, you're going to lose a ton of that upside skew. And if this volatility plays out, we will ultimately realize higher prices than somebody that just goes in and hedges. The other technique that people say is, well, I'm going to manage the low periods. If I have a high cost structure, I will just throttle my activity levels down. And the issue with that is, if you put delays in front of your production capacity by throttling back your operations, even if you say, man, it's 6 months from, I'm going to reduce spending but I can get it back in 6 months. We think these price signals come a lot faster, and you need to be ready to capture those. So I think look at this summer as a really great example. Prices blipped, and anybody that was sitting, to restart operations sort of missed that. So we don't think throttling activity levels is going to position you to capture the best prices. And the last thing is really, well, people say, well, you can have a high cost structure, but just pay down your debt and just carry no debt, and you could weather the storm that way. Well, to give you an example, and this is probably from our perspective as a large scale operator, our experience shows that large scale and high cost structure can be a deadly combination. So if you have a company that maybe has a break even of, call it $3, and you have no debt, and maybe you're large scale and you're producing, call it 3 TCF a year. EQT produces about 2.3 TCF a year. Every dollar, and gas prices go to $2. You'll lose that dollar margin of loss at that scale is going to translate to a $3 billion negative free cash flow. So how sustainable is your strong balance sheet after a year of that, after 18 months of that? That's why we think our approach, low cost structure, mitigate hedging, is going to give investors, we think, the best risk-adjusted exposure to natural gas prices, and that really is a driving force behind what we're trying to create here at EQT.
Yeah, but you also curtailed production this past summer. So how do you think about it specifically, for your company?
Yeah, I mean, I think that's a really important point, and we will, if storage infrastructure is no longer going to be the storage mechanism or effective, that's just going to back up into the operators. And so curtailing is going to be a significant part of our strategy, and we're flexing that when we have that opportunity to do it. Now, just keep in mind, when EQT has a tremendous amount to curtail, or the tremendous capability to curtail, this E-Train transaction removed one of our biggest considerations, which is these minimum volume commitments. Those are gone. So we're not going to pay penalties if we shut in volume, so we can do more. But really, the thing that's really going to allow us to flex our curtailments is our low cost structure, because when you curtail volumes, you're losing revenue, and that for operators that have a higher cost structure, their choice is curtail, lose revenue, and then they're most likely have to, with that lost revenue, they could be in it'll be really punitive on their free cash flow situation. So what you'll see them do is, to balance the lost revenue, they will throttle down operational activity and reduce the spend there to maintain free cash flow neutrality. We can go big on curtailments, take advantage of the market dynamics in front of our face, and not sacrifice our productive capacity and doing it. Jeremy's got his finger on that button for how we curtail. Jeremy, maybe just walk through a couple other details on some of the things you think about when you're pushing that button.
Yeah, I mean, a lot of it really comes down to cost structure, but I think after on a relative pad basis, so a pad with for example, a lot of water production, flowing, certainly now when we own Equitrains, flowing gas into someone else's gathering system where we're not paying ourselves, those are the first ones that we're obviously going to shut off. There's a whole kind of layer of constraint factors that we evaluate, but ultimately it allows us to have really like an opportunity set that we refresh a couple days before we actually anticipate curtailing, and we can do it very logically. So what you'll see when we do that is improved operating cost metrics typically, and improved realized pricing because we're selling less volume into the local market. I think it's also important to add to that, a lot of noise has been made about the amount of volume we sell in basin in Appalachia that's not firmly committed out of basin. We can only curtail like this because of that, right? If we were fully pabbed out of basin and we had these basically debt obligations to flow gas all the time, you can't really curtail or your cost structure explodes. So we're taking advantage of that with MVP coming online. After that's flowing at full capacity, we'll have around a BCF a day still in basin that we sell at M2. I don't anticipate that dropping much below that because we do see that as strategically important to be able to do exactly what we're doing. Otherwise, we lose the flexibility as an operator, and you're effectively forced to produce through, at times, what we think in a volatile world, a very low gas price environment, which is value destructive. So again, in our business overall, it's about low cost structure. It's also about flexibility. But for us, we try to build these frameworks out so we can operate very nimbly through these different environments.
So how do you view the company? So how do you create shareholder value? And by that I mean, is EQT just a commodity play on natural gas prices? I mean, you build shareholder value by, theoretically lowering debt. So if your enterprise value is your debt plus equity, your debt goes down, well, then your equity value should be going up. But beyond that, you're sitting on a ton of reserves. How are you going to go, grow production, and when does that, get realized?
Yeah, Jeremy, I'd love for you to maybe put some perspective on what we're seeing for some of the growth signals within Appalachia, the local demand that we're seeing, tagging that onto the initial part of Eve's question.
Yeah, for sure. I think the answer is really two-pronged. I think first, when you look at what's happening in the Appalachian region within PJM, these recent capacity auctions, and what that indicates for just the demand need coming, when you look at 3 of the biggest data center hubs in the country being in Virginia and Ohio and then Atlanta, which are basically surrounding our production base where we actually sell gas into those markets. By our modeling from our fundamentals team, we think the basin can actually, by the end of the decade, grow from like 35, 36 BCF a day now up towards about 41. And so just to put that in perspective, that's a whole additional EQT, right? And we're as of now, we're the largest producer of gas in the country. So it is a tremendous amount of growth. And I think when you step back and say, well, what about the supply side? Appalachia just keeps growing. Keep in mind, look at Coterra as a very public example, buying that Cabot asset. They're hardly spending any capital there anymore. I think at the Barclays conference last week, they were saying they're going to pull all their rigs and all their frac crews off it and just let it go into decline. You look around the rest of the basin, we didn't think Southwestern really had much inventory left of any quality. Certainly not in our neighborhood, not Northeast Pennsylvania. The Utica probably has through around the end of the decade an inventory life. We've seen some of those operators look to release FT capacity because they don't have the inventory to fully fill it. So you're seeing signs emerge where, by our estimates, about a third of the basin, as you get towards the end of the decade, will struggle to even maintain current production levels. So you have demand growing, supply becoming challenged, and I think the opportunity really sits in the hands of just a couple producers. So you have the haves and the have-nots. The Permian, I'd say same dynamic, right? It's a lot of inventory, but it's really held in the hands of a few, not in the hands of everybody equally. So I think we're in a position, not only with our inventory and that macro backdrop, but now we effectively own the toll roads, the pipelines in our part of the basin, where when that next molecule is needed, we're the cheapest producer to supply that molecule to the market. So I think the ability of EQT to grow even substantially and through the end of the decade is actually pretty amazing. I think it's counter consensus. People don't step back and think about it quite like that. And I'd say even within the basin, if you just had a flat basin level of production, your share of the pie can reallocate, right? Even if the basin didn't grow in our whole 40, 41 BCF a day forecast for demand, say that was just wrong. you're going to have other operators just pulling capital out of the basin and putting it elsewhere, right? Someone's got to backfill that production. We think ourselves and some of our other neighbors in Southwest Appalachia are really well positioned to do that. So we're excited about that opportunity.
So just to dumb it down for me, so what you're saying is you think you're going to get you'll gain market share, and do you think you'll also actually show production growth over the 25, 26 period from where you are today?
I wouldn't say we plan on anything beyond maintenance production near term until there is a clear, sustained structural market signal. I think the first signal you would see is basis in Appalachia starting to structurally tighten. It's around a dollar back from Henry Hub today. I think by our estimates, you'll probably see that trend back lower. And just for perspective, back in like 2021, 22, that was closer to 50 cents at times, right? Because you had extra pipeline takeaway capacity. I think you trend maybe not all the way there, but back that direction. And that's the signal that, hey, the market can take additional supply.
This is a little bit of the digression. Well, how do you think about the ultimate, increase in demand growth, for natural gas from two perspectives? One, you alluded to it, Jeremy, talking about, data centers, and power demand, and you have some really robust growth in power demand forecast. And the question I have is, is that realistic? Is the supply chain actually going to allow to be able to build all these data centers and will the infrastructure be there to do that? And then the second, major driver for natural gas demand is this thought about LNG exports, which Toby, is famous for unleashing natural gas. And then the third aspect would be, industrial demand. So maybe you could just talk about your thoughts around that.
Yeah, Yves, I think you're seeing what's playing out on the grid is similar to what we've seen on the pipeline capacity. Like we have maxed out, I think, the industrial capacity of our grid. And unfortunately, like we need to put more reliable energy power generators on there. I mean, the replacing coal, reliable power gen when you replace coal with natural gas is great. I mean, it's cleaner, but you don't sacrifice reliability. There's been so many intermittent sources put in. In California yesterday, we had an investor meeting. Our first meeting guy was late, and I said, "Hey, what?" He's like, "I'm so sorry, my power went out." I said, "Well, is there a storm or anything?" He's like, "No, just power goes out." And every investor that we talked to after that was talking about how their power goes out. I mean, this is going to be a theme that's going to continue to grow over time. And so why am I telling you that? Because the share of natural gas in this new power demand that's coming out, I think is going to be much greater than what people think. Our estimate's 75 gigs of power demand, 6 to 13 BCF a day to support that. I think the people that are demanding this power gen is going to, they've gone through a period where this last, call it 12 months, have explored all the options to get this power generation, from renewables to nuclear to existing capacity and taking that. I think they've come to the realization now that we just need the power. We'll figure out the environmental things later. And natural gas is going to be such a great opportunity to hit the speed that people need. For us in Appalachia, certainly having the connector to MVP is going to be great. We think that's just going to continue to strengthen more expansion projects on MVP, which we should benefit from. But the other interesting dynamic is going to be, we have a lot of like coal facilities that have been retired that have all the infrastructure, you have all the wires and electric infrastructure there. The only thing you need to do is bolt on, the natural gas power gen. Now, obviously, I'm simplifying it a bit, but we think, Appalachia could be uniquely positioned to go there. I mean, in addition to being the lowest cost source of energy in the country, or one of them. So we think we'll start to see some of these deals or opportunities start to crystallize or form over the next, I'd say, 12 months. And we're excited about that future. But yeah, we've already demonstrated the ability to do large supply deals and do it in a way that gets us a premium versus selling it locally. And that's going to be the theme for us with the power gen theme that's coming over the next couple of years. But
yeah, I would add to
all this stuff, just for perspective, this is sort of like, call it later half of this decade. I mean,
Right.
where these things really start hitting, but it's going to be an opportunity for us to put these catalysts into the future for us, just like we've done with that physical supply deal that will increase our free cash flow by $300 million a year, which starts up, call it 2027. Start putting some power opportunities behind that.
And what was that deal that you just mentioned?
Good. That was taking our MVP capacity. It was a physical supply deal we did with some utilities. Jeremy, you want to put any color on that, or I know you were trying to jump in.
Well, what I was going to say, and I'm happy to provide a little color on that, but what I was going to say is, I think from like one of the pieces of your question around like, is that growth in electric demand real? Look at the last 10 years as just like a case study and what's happened. You've had flat load growth. I mean, no load growth. It's been flat. But gas demand for power has grown from like 23 BCF a day to about 35 on an annualized basis today. So you've added 10 to 12 BCF a day of demand with no load growth. You still have about 16 BCF equivalent of coal being burned in the country today, right? So that trend should continue absent any of this data center stuff and whatever, electrify everything, whatever themes people want to believe that's going to drive load growth higher. So I think that's what's changing for us is there's nothing really changing actually at all. It's just, is it going to inflect and get even better than what it's been? So it's really a continuation of the same theme. So I think the level of riskiness in the assumption that gas demand for power will continue to grow is pretty low. It's just been happening for a long time. And then I think I was getting Toby's, or I guess one of the last questions on the deal with our MVP capacity. Yeah, look, we resold that capacity to two of the big utilities in the Southeast. There's a scarcity for gas in the region. I think the pricing we received on a firm 10-year basis reflected that. So that's something that I would say that amount of gas probably supports 8 to 9 gigawatts of additional generation build out. Some of that's coal retirements, some of that's new power generation. But those utilities, they don't really have another option. ACP was canceled, other pipelines that were trying to be built to serve that region. The region needs the gas badly right now. MVP is really the only pipe that got completed to feed that. So I think the capacity on that pipeline and the capacity created through the expansion we're going to pursue is increasingly viewed as very, very valuable because there's a scarcity factor to it.
Yeah. But what I was going to say is, to me is, life is all about expectations. And I totally get what you folks are talking about. And I think that the slope of the line is definitely up and to the right. I'm just concerned about the steepness, of that slope. And that frankly, concerns me a little bit, just, how fast we get there. And then, having said that, and then we can talk on LNG and, what your strategy is in terms of locking in LNG capacity, get international pricing. But, in the few minutes we have left, I really, what do you, the presidential election coming up, how important is that to what you guys do? If it's a Democrat or Republican, what are the ramifications in your minds of the outcome of the election?
Even I think when you look back, energy prices are higher under Democratic leadership. So, that's what I mean. We think about that pretty. The only other thing I'd say is like, I mean, what we're looking for. We're in this situation because political forces overwhelmed market forces, and you see that the world that we're in, I mean, energy security of our allies is crippled. And global emissions are still skyrocketing. Inflation is running rampant. We need to get back to a place to fix this. We need to get back to a place where the market forces dominate. And we hope that we can ultimately end up with an administration that will let the market fix this. And that means we need the administration, we need our leaders in government to properly value the key attributes about energy, like the cost effectiveness. That's pretty simple. But how are we valuing the reliability of the energy that we deliver and consume? How are we valuing the carbon aspects of the energy we consume? I mean, that last one, it's kind of completely fragmented. Nobody knows holistically how we're valuing the carbon intensity. So there's an opportunity to, I'd say, streamline how we value the carbon intensity, and there's a huge opportunity to put some value on reliability. That's not a huge lift, but if you could properly value those things and incentivize the market to go after that, then I think we can be in a really great place where we'll reduce some of this volatility and present some more opportunities for this industry. I mean, and the one thing that I'm encouraged, I'd say just watching the discourse, over the last like 4 weeks, you're seeing that natural gas has, I'd say, broken from the pack and is now considered to be like apolitical. People know it's decarbonizing. People know it's the key to energy security. And so we'll keep banging the drum on natural gas, but like ultimately what we really need to be advocating for is getting proper value on the reliability and carbon aspects of the energy we produce.
Are you seeing any premium for the carbon intensity on the on your gas?
No, I mean that's
Not yet.
that's one of those areas. I mean, right now, our net zero, I'd say tag on our business, there's really not a lot. That is really just a license to operate. But if you could come up with a mechanism where you could look at the carbon intensity of our gas versus average, figure out the amount of carbon you're saving and put some type of mechanism on that, that would be an easy framework to really convert that into dollars. But Yves, we're gonna continue to do everything we can to lower our carbon footprint on the scope 1 and 2. And it's not a significant amount of dollars for us to do that, but we think others in the industry will continue to make significant strides. I mean, on methane, industry I think is down 30% on methane emissions. So I mean, this industry is going to solve this and take away one of the biggest environmental concerns in our industry, which is methane. And down the road potentially could be a way to create some value off that.
As you go to, as you visit with the politicians, is there more support for permit reform? Do you think that happens anytime soon? Or...
I mean, yeah, like this is a situation where I don't care who you are, like, or what you're trying to build, like it's hard. And if you think it's hard to get a pipeline built, try getting a transmission line built. If you think it's hard to get a 10-acre oil and gas location approved, try getting a 10,000-acre wind farm. So, I think a lot of the easy things on the renewable side have been done and are behind us, and they're in the same exact camp that we're in. We need permit reform to be able to do what we do. And as I mentioned before, we've sort of hit the wall on the industrial capacity of this country. It's maxed out. And that means you're going to start seeing some incidents. And not just going to be the people in California that are talking about the electricity shortages. And this power demand for AI is going to be, I believe, the straw that breaks the camel's back. It gets us back to a place where we're doing like real practical things to get back the building in this country.
Yeah. And how's unleashing LNG going?
Well, Yves, it was people ask me that a lot, and I would say it's going great. But then people say, well, Tob, the result of those efforts ended up with an LNG ban. So how good is that? Well, I'll tell you this, my takeaway from that, the fact that environmentalists have put a little bit of a target on LNG is a sign that we've been making too much noise and it's been making too much sense. I'd say the biggest benefit we get from the Unleash US LNG campaign is we have to find the attributes of energy. Energy needs to be cheap, reliable, clean. That's it. And now that we can focus on the attributes, we can start grading what energy is better than other energy. And while we've seen natural gases, we're getting closer to that all of the above approach towards energy. And you just look at the sentiment around natural gas. So we're moving closer to that all of the above approach. But if we want to fix these problems that we see, if we want to protect the 60% of Americans live paycheck to paycheck, if we want to help the billions in the world that live on less electricity it takes to run a fridge, we want to meet the climate ambitions that people have on the timelines. They say, like, we need to move faster. We need to move from an all of the above to a best of the above approach. Having the right attributes is going to be a great, I'd say, centralizer for people to think about the decisions and are they really doing the best things possible. And when you look at natural gas, you will see it as the best form of energy when you look at those three attributes.
But when you think about the sentiment changing, is that primarily just domestically? I mean, or are you starting to see it, internationally? Because it seems Europe is pretty, pretty adamant in terms of the direction that they want to take.
Yeah, Eves, I mean, coming out of this, we're still in this crisis over there. But a lot of people have been scratching their heads because it seems like Europe has said they're going to double down on solar and wind.
Also, nuclear too, I think, is starting to
Yeah.
gain some prominence.
Yeah, and I just have people like understand. I mean, there is their mentality. I think they think that solar and wind. I mean, the statement that you hear is nobody controls the sun, nobody controls the wind. So like that is their ultimate form of energy security. Obviously, we're all just like, that's not, intermittent sources are not a true form of energy security. But we got to continue to show them that partnerships they create with American producers, we're driven by market forces, not political force, and we'll create, I'd say, the most energy secure options. That's why that LNG pause was so destructive, if I'm being honest with you, because it was a signal that we're going to have political force on our markets, which is was a big step backwards. And you look at the reaction from Europe. I mean, they're pissed, and they've come out and said, America is the global guarantor of energy security for the world. So we need to get this thing fixed. And I think the outrage on the LNG ban is a sign that we've made a lot of progress, to see the bipartisan pushback saying this is poor within our country, and then to see our allies step up and say this is a bad decision, and also see people say that this is a step backwards for climate. I think are good signs that people are getting smarter. And when I go to sleep at night and I think about this world, and I know it's getting crazy, I am hopeful in thinking that people can only get smarter about energy, and we're seeing that people slowly inch along. People will get there.
Well, good. Yeah, I want to be mindful, because I said 45 minutes. It's close to an hour. But just a couple of quick points. One is yesterday I was at a Net Power event, which could be a game changer in terms of clean burning natural gas with essentially zero carbon emissions, and just talking the EQT book. If they're successful, 1,000 net power plants would consume about 50 BCF of natural gas, by 2040. That's a huge amount. So, that would be a real game changer. I'm not sure if there's any other technologies out there, but that's sort of a segue. And it wasn't, well, the segue is, what do you think about hydrogen, CCS, and whatever closing remarks you might want?
Yeah, so the super long term, the race that every energy producer is in, whether they like it or not, is the race to be the first energy solution that is affordable, reliable, and zero carbon. And so we think natural gas is going to win that race, and technologies like Net Power are going to be the cars that drive us across that finish line. When we compare renewables, they're affordable and they're clean, they're zero, but they're not reliable. So is batteries going to get them there? I think that's going to take a long time. I'm not as concerned about the battery threat. Nuclear is reliable and it's zero, but it's not affordable. So are people going to get their act together and streamline the permitting process and lower the costs on that? We think natural gas is going to win. Hydrogen is one pathway for us to take natural gas to zero carbon. I don't think that's going to be the most cost-effective way for us to make natural gas a reliable zero carbon energy source. It's going to be carbon capture. And I think as Danny points out, like in this country, not only do we have massive natural energy resources, we have massive like resources that will contain carbon. And when you think about our ability to store the carbon is going to be, I think, the bottleneck in how fast we can move towards zero carbon natural gas solutions. The good news is, though, is we already have assets that are connected to reservoirs that will store fluids like CO2. And that's our existing infrastructure. Like our depleted wells are a great place for us to look at storing CO2. And when you step back and say, like, how big could this be? Every day in this country, we produce 13 million barrels of oil. We're producing another 38 million barrels of water. So every day we're producing, call it 50 million barrels of fluid. We're creating 50 million barrels of space for something else to go in there, like CO2. So keep an eye on the CO2 regulation. I think that this, just given how transformative this could be, I think that may be the next place that environmentalists start looking at and challenging. But we're optimistic about the opportunities we have, and with companies like Net Power, that's the technology catalyst. And then with 45Q, we've got the value of the CO2. That's been an important catalyst. So we've got the incentives to do it. Now we just need to connect the dots and make some of this stuff happen. And we're testing this at EQT. But that's in our new ventures program. We're probably most excited about that out of all the things that we're doing.
That's great. Well, thank you so much. Really, real generous with your time. Really appreciate it. Toby, Jeremy, Cam, thanks so much, and keep the faith.
All right. Thanks, Eves.
Take care. Thank you.
Bye.
Get it.
Bye.